Imagine waking up in a city filled with skyscrapers, wide highways, shopping malls, schools, luxury apartments. But there is no traffic noise, no children going to school. There's no lights in the windows at night, and no life inside the buildings. Everything looks modern, expensive, and successful, yet almost no one lives there. This is not a movie scene, and it is not a future prediction. This is happening right now in China, the world's second largest economy. And it represents one of the most dangerous property bubbles ever created in human history. For years, China was seen as an unstoppable economic miracle. Cities rose at unbelievable speed. Millions were lifted out of poverty. And property prices seemed to move only in one direction, up. To ordinary people, real estate looked like the safest bet imaginable, a guaranteed path to wealth and security. Families poured their life savings into apartments they never planned to live in. Investors bought multiple units simply to hold them, and developers built entire cities before demand even existed. The belief was simple and powerful. Property prices would always rise, and the government would never allow the market to fail. This belief became the foundation of China's housing boom. And it is the same belief that once fueled housing bubbles in the United States, the United Kingdom, Japan, Spain, and Ireland. The only difference is scale. China did not just build too many houses, it built more housing than the rest of the world combined over a few decades. Real estate and related industries grew to represent nearly a third of China's entire economy, meaning that property was no longer just an asset class, it became the engine keeping growth alive. Local governments relied on selling land to fund public services. Developers relied on endless borrowing to keep construction going. And households relied on rising prices to justify buying homes they didn't need. Because China tightly controls its financial system, ordinary people had very limited investment options. Bank savings paid low interest, stock markets were volatile and unpredictable, and moving money overseas was heavily restricted. Property became the default investment, almost a national obsession, and social pressure reinforced it. In many cities, owning a home became a requirement for marriage, a symbol of success, and a measure of personal worth. As demand appeared endless, developers rushed to build more and more, often using enormous amounts of debt. Apartments were sold before construction even began, allowing developers to use buyers' money to fund new projects, while also borrowing heavily from banks and shadow lenders. As long as prices kept rising, this system looked stable. Rising prices made everyone feel richer, encouraged more borrowing, and justified even larger construction projects. Entire districts and cities were designed years in advance, filled with high-rise towers, artificial lakes. It's in European-style architecture. Yet they remained largely empty because they were never meant to be lived in. They were meant to be held as investments. These ghost cities were not accidents. They were a direct result of a system where speculation replaced real demand. The real danger, however, was hidden beneath the surface: debt. Developers like Evergrande became some of the most indebted companies on earth. Owing hundreds of billions of dollars, their business model depended entirely on constant sales and constant price growth. The moment sales slowed, the entire structure began to shake. That moment arrived quietly. In smaller cities, prices stopped rising. Then construction delays began. Buyers who had paid for unfinished homes realized their apartments might never be completed. Confidence, the most important ingredient in any bubble, started to crack. Once people began to question the idea that property prices could only go up, the system rapidly weakened. Developers struggled to refinance debt, banks tightened lending, and local governments faced falling land revenues. In response, authorities tried to control the damage without allowing a full collapse. But this created a slow, grinding crisis instead of a quick correction. Projects were frozen, apartments remained empty, and millions of households were left holding assets that could not be sold at expected prices. The illusion of endless growth had finally met reality. For audiences in the United States and the United Kingdom, this story should feel uncomfortably familiar. Before the 2008 financial crisis, American homeowners believed prices would never fall nationally. In the UK, property has long been treated as a retirement plan rather than just a place to live. In every bubble, the same logic appears. This time is different. Demand will never end, and the government will step in if something goes wrong. China's ghost cities expose the flaw in that thinking. Housing markets are driven not just by supply and demand, but by psychology, debt, and confidence. When prices rise faster than incomes for too long, when homes are bought not to live in but to speculate, and when debt grows faster than the real economy, risk silently builds. China's housing crash is not just a domestic problem. It affects global markets, commodities, banks, and investor confidence worldwide. More importantly, it serves as a warning. Ghost cities are what happen when an economy confuses construction with prosperity and speculation with wealth. They are physical proof that prices alone do not create value, and that markets built on belief rather than fundamentals eventually break. The collapse does not always come with a dramatic explosion. Sometimes it arrives slowly, through unfinished buildings, falling confidence, and years of stagnation. China's experience reminds us that no housing market is immune, no matter how large. Controlled or successful, it appears. When the belief in endless growth disappears, even the tallest skyscrapers can become empty monuments to a broken promise. What happens when a government that promised stability faces a crisis too big to hide, yet too dangerous to fully confront? China's housing collapse did not explode like the American crash of 2008. Instead, it began to suffocate slowly, quietly and painfully, like a fire with no visible flames but endless smoke. When developers started missing payments and construction stalled across the country, the Chinese government stepped in not to save the market, but to control the narrative. Authorities knew one brutal truth. If confidence collapsed completely, the damage would spread far beyond property into banks, jobs, pensions, and social stability itself. So instead of allowing prices to fall naturally, they attempted a controlled slowdown, a balancing act that has historically failed every nation that tried it. Developers were told to reduce debt, but continue building. Banks were encouraged to lend selectively while pretending risk was contained, and state media reassured citizens that the fundamentals remained strong. But markets do not run on slogans. They run on cash flow, trust, and belief. As Evergrande and other giants slipped deeper into crisis, millions of ordinary Chinese families were trapped in a nightmare scenario, still paying mortgages on homes that did not exist, in cities that never filled. In a market that no longer moved, mortgage boycotts quietly spread, something previously unthinkable in China, signaling a dangerous shift. People no longer believed the system was fair or functional. At the same time, local governments once addicted to land sales saw revenues collapse, forcing spending cuts and hidden borrowing just to survive. This created a feedback loop where every attempt to stabilize the market only exposed deeper weakness. Prices could not rise because demand was exhausted. They could not fall because too many balance sheets depended on them staying high. This is the most dangerous phase of any bubble, not the boom, but the denial. For investors watching from the United States and the United Kingdom, this phase should feel alarmingly familiar. Japan experienced it after its 1990 property collapse, entering decades of stagnation. Southern Europe lived through it after 2008, when governments delayed reality and prolonged pain. China is now facing the same choice every bubble nation faces, except short-term collapse or endure long-term decay. And decay is already visible. Youth unemployment surged, consumer spending weakened, and households stopped seeing property as a wealth machine. The psychological damage may be even greater than the financial loss. When a society builds its dreams on rising asset prices, and those prices stop rising, trust erodes not just in markets, but in institutions. This is why China's housing crisis matters far beyond its borders. Global supply chains, commodity markets, luxury brands, and international banks all depend on Chinese growth. A property slowdown in China does not stay in China. It ripples outward, quietly tightening financial conditions worldwide. For Western audiences, the most important lesson is not about China's political system or planning failures. It is about human behavior. Every housing bubble tells the same story. Leverage disguised as prosperity. Speculation sold as security, and risk ignored because recent history feels permanent. In the US and UK, policymakers often argue their markets are different, more transparent, more regulated, more mature. The same arguments were made in Japan, in Spain, and now in China, yet gravity always wins. When housing becomes unaffordable for ordinary people, when investors dominate supply, and when debt grows faster than incomes, fragility is guaranteed. China's attempt to manage its collapse teaches us that governments can delay pain, but they cannot erase it. The longer reality is postponed, the longer growth disappears. Ghost cities are not just empty buildings. They are frozen capital, trapped savings, and lost opportunity. They show what happens when economies confuse construction with wealth and price appreciation with productivity. For viewers who want to understand where global markets are heading next, ignoring China's housing crisis would be a mistake. It is not just a story about apartments and debt. It is a story about confidence, control, and the limits of intervention. And this story is far from over. In the next chapter, we will examine the question no one wants to ask openly. What happens if China's property market never fully recovers? And what that future could mean for housing, investing, and economic stability in the US and the UK. If you want to stay ahead of the cycle instead of reacting to it, this is exactly the kind of story you need to follow, because the biggest financial risks are never the ones everyone is talking about. They are the ones still being managed, delayed, and denied. As China's housing market drifts deeper into uncertainty, the most uncomfortable question is no longer whether prices will fall or stabilize, but whether this market will ever return to the role it once played as the engine of growth. Because history suggests that when a property bubble reaches this stage, the damage is not just financial, it is structural. Once confidence is broken, it rarely comes back quickly. In China, generations were taught that property was safety, property was success, and property was the future. Yet today, millions of families look at empty apartments and unfinished towers not as assets, but as frozen money and broken promises. This shift in mindset is critical because housing markets do not recover on stimulus alone. They recover when people believe again, and belief cannot be ordered by governments. Even if China injects liquidity, lowers interest rates, or relaxes buying restrictions, the deeper problem remains. Demand has already been pulled forward from the future. Homes that should have been bought over the next 20 years were bought in the past 10. This creates a long shadow of stagnation, where construction slows, prices drift sideways or down, and growth becomes harder to generate. Japan learned this lesson after its property crash in the 1990s. When cities remained functional, but values never fully recovered in real terms for decades. China now risks entering a similar phase where ghost cities do not suddenly fill up, but quietly age, representing capital that could have been used for innovation, consumption, or productivity. For the United States and the United Kingdom, this story carries a warning that is easy to ignore but dangerous to dismiss. Western housing markets may feel different, but the underlying pressures are strikingly similar. Rising prices disconnected from wages, younger generations locked out of ownership, investors treating homes as financial instruments, and governments relying on property values to maintain economic stability. In both the US and UK, housing has become political, emotional, and deeply tied to national identity, which makes corrections harder to accept and easier to delay. China shows what happens when delay becomes policy. Instead of a sharp reset, economies endure years of uncertainty, low confidence, and reduced opportunity. Global investors are already adjusting to this reality. Slower Chinese growth affects demand for commodities, luxury goods, higher education, tourism, and even Western real estate markets that once benefited from foreign capital flows. When Chinese households stop feeling wealthy, they spend less globally. When developers stop building, global supply chains feel the impact. This is how a domestic housing crisis becomes an international economic drag. But the most important lesson is not about China's political system or planning mistakes. It is about human nature and financial cycles. Every generation believes it has discovered a safe asset that cannot fail. Every cycle convinces people that fundamentals no longer matter, only momentum. And every cycle eventually reminds us that debt amplifies both gains and losses. China's ghost cities stand as physical evidence of what happens when speculation outpaces reality. They are not just empty buildings. They are warnings made of concrete and steel. For viewers in the US and UK, understanding this story is not about predicting an identical collapse, but about recognizing vulnerability. Markets do not need to crash to cause harm. Sometimes they simply stop delivering the future people were promised. That disappointment changes behavior, politics, and policy for years. As China navigates this uncertain path, the world is watching, because the outcome will shape how governments respond to housing stress everywhere. Will they allow prices to adjust, or will they protect valuations at the cost of long-term growth? Will housing remain shelter, or will it continue to be treated as a speculative asset? These questions are no longer theoretical. They're playing out in real time. And the answer matters to anyone who plans to buy a home, invest, or simply understand where the global economy is heading next. Because the biggest financial risks are rarely sudden disasters. They are slow shifts in confidence that most people notice only after the opportunity is gone. If this video, HCLGI to subscribe, Kara.